Good afternoon, and thank you for tuning in to today's webinar concerning the topic of the FCA's capital adequacy regime. This is a Buzzacott production exclusively for our fellow AIMA members. My name is David Jarman and I head up Buzzacott's Financial Services Specialism. For those that haven't heard of us, Buzzacott are a leading niche-focused accounting firm in the UK. We have almost 450 members of staff that, up until mid-March, were all based at our offices in the City of London. For over 20 years, we have supported UK and US alternative asset managers, providing services that range from audit, tax and accounting to payroll, company secretarial, FCA and Annex 4 reporting. The current pandemic has led every industry and business worldwide to assess how they will be impacted over the foreseeable future. For the UK financial services sector, rules introduced after the banking crisis have arguably put regulated firms in a better position than those operating in other industries. Capital buffers, additional risk capital, and detailed business continuity plans have allowed most to better adapt and react to a very different world over the last 2 months. Whilst the specific ramifications of COVID-19 may have been hard to predict, the impact that a market crash or a major disaster are scenarios commonly built into risk mitigation plans and ICAAP documents. It is certainly interesting to see that those who have previously gone through a more thorough assessment process have typically been better prepared. During today's webinar, we'll be having a recap on the capital adequacy regime, how it impacts different types of categories of firms, and emphasising the areas that require closer attention at the moment. We'll be giving an overview of the FCA's stance during the pandemic and touch on some of the key announcements made recently. Finally, we'll also cover some of the tax considerations that are likely to be relevant when considering the capital structure of a regulated business. My role is now to hand over to our experts, and for the next hour or so, stop my dog from barking, hope Amazon don't deliver, pray the Wi-Fi doesn't fail, and try to prevent the phrase "you're on mute" being repeated too many times. And so to our speakers who are allowed to introduce themselves. First to Priya Mehta, who heads up our award-winning FCA advisory and reporting team. Priya, hello.
Hi, David. Thank you. Good afternoon to all delegates who have joined us for the webinar today. My name is Priya Mehta. I'm a partner at Buzzacott and I also head up our prudential reporting and advisory practice. I've been with Buzzacott for nearly 12 years now, working with various types of regulated businesses, and I'm absolutely delighted to be speaking here today. Over to you, Johnny.
Thank you, Priya. Good afternoon, everyone. I hope you're all keeping safe and well, and thank you for joining us. I'm Jonathan Alsalvador. I've been working at Buzzacott for more than 12 years now, focusing on regulatory reporting and advisory services, including ICAAPs and Annex 4 reporting for asset managers, hedge fund managers, and private equity firms. Over to you, Antoine.
Johnny, good afternoon all. Thank you very much for taking the time to join us today. My name is Antoine Housden. I head up the financial services tax practice at Buzzacott. I've been working in asset management tax now for over 15 years. And have spent my career supporting alternative asset managers, their investment products and their principals.
Sorry about that. First faux pas. Jonathan, if we can start with you. Do you want to talk us through how capital resources are calculated and the different requirements that apply to different categories of authorization?
Sure, thank you, David. Yeah, just the general requirement for all regulated firms is to ensure that they maintain sufficient financial resources so they can meet liabilities as they fall due, and most importantly, to protect consumers. Now, in order to assess whether firms have enough financial resources, firms need to calculate the capital resources available in accordance with the relevant accounting framework. And our capital can take various forms depending on its quality and permanency. For instance, common equity tier 1 or tier 1 capital would be made up of either fully paid ordinary shares, share premium, audited P&L, or members' capital for LLPs. So generally, tier 1 capital typically has the following characteristics, in that it's able to absorb losses, it's permanent or available when required, and it has no fixed costs attached to it. So as you can see, there are other tiers of capital, but please do be aware that these are restricted to a certain percentage of Tier 1 capital after deductions. So, for example, Tier 2 capital is limited to 50% of your Tier 1 capital, or adjusted Tier 1 capital. So in arriving at the total capital available, firms need to determine whether any deductions need to be made. For example, material interim losses incurred to date, negative reserves, and goodwill, for example. For LLPs, it is important to note that excess drawings over profits available need to be deducted. Now, while these are often included on the balance sheet as an asset, they are reliant on the business making sufficient profits to cover these, and so need to be deducted. So once this number has been calculated, this total then needs to be greater than the firm's overall capital requirement. And I'm just going to go through the different types of investment firms and an overview of their corresponding capital requirements now. So to start with, the categorization of investment firms is dependent on the regulatory permissions it holds, and therefore the activities it's carrying out. And that in turn will give each type of firm a base requirement or base capital requirement that must be maintained at all times as an absolute minimum. These base requirements reflect an increase with the level of risk that the firm is taking in its activities, ranging from €50,000 for exempt CAD and BIF-proof firms to €730,000 for full scope if-proof firms. So we're just going to touch upon the Pillar 1 capital requirements, which again decrease in size and also complexity as the risk levels increase. So to start with, exempt CAD firms such as advisors or rangers just have a capital requirement of €50,000. BIF-proof firms and if-proof limited license firms, whether it be 50k, 125k or 730k firms, have a similar methodology in that their capital resources must exceed the higher of the fixed overhead requirement, also known as FOR, or the sum of the market risk and credit risk capital components. CPMs or CPMIs under AIFMD need to calculate an FOR as part of their capital requirement, as well as needing to calculate a requirement based on a component of their funds under management. Now, the funds under management definition is the absolute value of positions plus the market value of derivatives in the fund or funds that they are managing. These firms are also required to hold own funds to meet either the funds under management towards professional negligence or meet the professional indemnity insurance capital requirement, which would be the excess of that policy that they hold, assuming that it meets certain conditions. And for completeness, full scope if-proof firms, while not having to calculate an FOR as part of their requirement, have a more complicated calculation that they need to add on the operational risk and concentration risk, which is also known as the large exposure risk. They need to add these components onto their calculations. Just finally, for BIF-proof CPMIs and if-proof firms, these are subject to ICAAPs and the Pillar 2 assessment, as well as having the requirement to make Pillar 3 disclosures available publicly on an annual basis at least. And firms regulated under AIFMD also need to meet an additional liquid assets test. So now we're just going to go through a quick overview of the various risk components that different types of firms have to consider in order to calculate their capital requirements. So for most firms, credit risk and market risk need to be calculated. Now, credit risk is the measure of the risk of a default of a firm's receivable asset balances. This is typically 8% of the risk-weighted assets. And then the market risk assesses a firm's assets and liabilities and the risk of loss due to market fluctuations, such as movements in FX rates. Full scope if-proof firms need to calculate operational risk, which is often based as a function of the firm's average turnover for the last 3 years, and also concentration risk, which is the risk of a firm's exposure to a single particular counterparty. Although not applicable to full scope firms, as you can see, the diagram does highlight the importance of the fixed overhead requirement to a lot of investment firms.
Yeah, thanks, John. I mean, I guess, yeah, just with regards to the fixed overhead requirement, do you want to, I guess certainly for a lot of our smaller clients, that's the key determinant for capital resources. Do you want to give us some more background on this and talk us through how that is actually calculated?
Sure, thanks, David. Yeah, just to answer your question, it's worth going over the definition of the FOR, which is calculated as a quarter of what's called the relevant fixed expenditure. So it's worth noting that the definition is generally similar for BIFPRU, AFIMS and IFPRU firms. For established firms, the starting point is typically the total annual expenditure as per the latest audited accounts. Firms can then elect to make a series of deductions for non-recurring or non-guaranteed costs as per the following list. For example, staff bonuses, profit shares, or maybe one-off structural costs of the business. Just in the current climate, firms have the ability to adjust the FOR if there is a material change in the run rate to date. I mean, practically at the moment, we are seeing firms trying to reduce costs such as rent, staff costs, and maybe reducing their marketing spend. Now, while reducing costs in the short term may indeed result in a material change to a firm's fixed overheads, firms should really be considering whether or not this is just a temporary reduction, in which case it may not be relevant to deviate from the amount calculated as per the latest accounts. Firms should only be really reducing their FOR where there's a permanent reduction in the cost base of the business. However, where firms are adjusting the fixed overhead requirement, particularly downwards, they should make sure that they document their calculations and review and update their forecasts accordingly. It's also worth mentioning that for AFIMS and IFPRU firms, if the calculation does change by more than 20%, firms should be adjusting their FORs accordingly.
Okay, thanks, Jonathan. And so I should have mentioned before we started, for those who don't realise how these these Teams webinars work, there is a live Q&A section where you can post questions. I'll try and raise as many as I can, but obviously there's quite a few logged on to the webinar. But if not, we can follow up afterwards. Yeah, I mean, I think the difference between temporary and permanent is actually quite important, I think. And if people are reducing costs now, I guess we need to look at whether or not that's just for the short term, especially I guess with regards to staff costs if they're being reduced. Although I guess with regards to furloughing, that's not necessarily going to reduce your expenditure anyway, because I guess the furlough grants coming in are probably treated as income in nature, Johnny, not necessarily reducing your overheads.
Absolutely. So the grants are treated as income, as you rightly said, but firms are still contractually obliged to pay their employees, and this cost is still recognised in the P&L as a fixed expense. Also, as the grant is a temporary measure, once the furloughing period has ended, it would be expected that the firm's overall net cost would go back up, and therefore this doesn't represent a permanent reduction in costs or indeed the FOR.
Yeah, okay, good, thanks. So that's kind of pillar one. Priya, moving on to pillar two, what are the pillar two obligations that most firms face?
I do believe that looking above and beyond the capital adequacy calculations is not just important in the current scenario, but has been an expectation throughout. It is more important now than ever before to identify and assess all risks from an operational and financial perspective. Some of these risks would have actually materialized in the past few weeks. Basic questions as to how did you handle them? What actions did you take to control damage? Who made the key decisions? Was there a monetary impairment or additional spending because of any of those risks occurring? The key message from the FCA in the past few weeks relates to being able to demonstrate financial and operational resilience. Yes, of course, they've extended the deadlines for some FCA returns to allow firms to collate the required information as accurately as possible, but this does not mean that the regulators are less vigilant or less interested in any information that you're supposed to send them. And in fact, as a firm, you must ask yourself, have you done adequate analysis and documentation of your risks to ensure that you will not be in a precarious situation with the FCA should they choose to look into your compliance or operations at the moment. So with that as a background, I wanted to talk through 4 crucial elements of a complete Pillar 2 assessment. Of course, bearing in mind that a formal Pillar 2 assessment is currently not applicable to exempt firms, but some of the points I want to talk about could be classified as just best practice from a robust business continuity planning perspective. So in my opinion, all firms must take note of this. The first one is the preparation of realistic financial projections for the next 12 months at least, as granularly as possible, and compare them with actual results on a month-by-month basis. Use these projections for a detailed estimate of capital adequacy, so you roughly estimate when the next capital injection may be necessary, taking into account any expected losses during the year. The requirement under GenPru 1.2.26, if I were to quote, is that firms must at all times maintain overall financial resources, including capital resources and liquidity resources, which are adequate both as to the amount and quality to ensure that there is no significant risk that its liabilities cannot be met as they fall due. This puts an ongoing responsibility on you to monitor your position and have measures in place to ensure that no breaches occur. So as a tip, I would suggest increasing the frequency of monitoring your capital adequacy position. My second point is an extension of your best estimate projections into stress testing. Stress test what your capital and liquidity looks like if your revenues halved or if you didn't have any income at all for the rest of the year. How long would the business carry on? And think about the worst case scenario. The key requirement here is to not just throw open the scenario, but articulate how senior management will fix it, what remedial actions would be necessary. I would strongly recommend at least 3 or 4 scenarios to be stress test. At an operational level, you may want to consider what if there's a massive trading error or a cybersecurity breach. And in fact, the FCA mentioned in one of the consultation papers that was issued last year on assessing adequate financial resources that I would like to quote here, that firms must consider what if scenarios and estimate the potential impact. This is to determine the amount and type of financial resources needed to put things right when they go wrong. The next and arguably the most important one is to construct a risk register or a matrix which clearly articulates the likelihood and occurrence of all types of operational and business risks, specific controls in place to handle them, identifying senior managers with ultimate responsibility for monitoring and quantification of capital required to cover those risks. A typical risk register should bring out at least 50 to 60 different risks discussed under 12 broad headings mentioned within the FCA handbook. So a lot of guidance actually sits within the FCA handbook, which should drive the Pillar 2 capital framework that they expect firms to have documented diligently. From an operational perspective, firms should examine their current infrastructure, resources, or third parties upon which they heavily depend. It is essential that the firm's agreed qualitative and quantitative risk appetite and risk thresholds are reviewed, and that there are relevant compliance, monitoring, and reporting processes in place. The last element of the Pillar 2 assessment is wind down planning. Now, not many firms actually use the wind down planning guidance that is within the FCA handbook, which sets out its expectations from firms to document the process they intend to follow for an orderly wind down. We're certainly not suggesting to wind down businesses, but just highlighting an expectation to have a written plan in place. Guidance states that besides having a clear-headed and prompt decision-making ability, it is important to articulate a wind down plan at an operational level. The starting point of the wind down timeline is the decision, and the end point is the successful cancellation of the regulatory permissions. But the planning is all about the numerous tasks and challenges in between. So typically a wind down plan gives a clear picture on the governance process, the operational analysis, estimated revenues, costs, and resource assessment.
Okay, thanks, Priya. I guess, Johnny, coming to you. The difference between capital and liquid assets often requires clarifications, and I guess with just because a lot of money in the bank doesn't mean you're necessarily meeting requirements. Can you perhaps talk us through the definitions of the liquid capital and problems you sometimes see?
Yeah, sure. Thanks, David. It is a question that we do get quite often, and then, like I said, there is a confusion in the difference between capital in the business and liquid assets available. As we've already mentioned, Tier 1 capital needs to be able to absorb losses. It needs to be permanently invested in the business and have no fixed costs. Liquid assets are obviously cash, and also assets that can be converted to cash quickly if needed to meet financial obligations. And these are defined under MiFID as assets that can be converted into cash within 90 days. For CPMIs and CPMs under AIFMD, these assets would need to be readily converted to cash within a month in order for these to be used for the firm to meet their liquid assets requirement, which is reportable on a biannual basis, but obviously needs to be met at all times. The confusion may arise where a lot of firms have sufficient cash in the bank, but don't realise that this doesn't necessarily correlate to the firm's capital resources. For instance, they could also have large creditor balances by deferring tax or PAYE payments in light of the new government schemes, or even just loans on the balance sheet that would reduce this cash balance once paid. Firms could also have significant unaudited profits and realise the cash for these, but again, these do not qualify for as regulatory capital. On the other hand, while capital may be put into the business to meet working capital and regulatory capital requirements, it can often be tied up in illiquid assets such as fixed assets and deposits. It should be noted that goodwill, which is an asset on the balance sheet, is also deducted for the purposes of calculating a firm's regulatory capital. From the regulatory capital side, some firms have issues where they may have had a good year, and while they may have significant cash balances, they can often find themselves in a breach position, albeit temporarily. For instance, for fund managers, a large performance fee at the year end could trigger a spike in both credit risk and market risk, which could cause a temporary capital adequacy breach. So firms really need to be actively looking forward in order to avoid such situations. And as mentioned before, AIFMs have to calculate their capital requirements based on their gross funds under management. Now, given that firms need to be meeting these requirements at all times, and not just at the reporting period end, we recommend that this calculation based on the gross funds under management is performed and monitored on an ongoing basis to avoid any unnecessary capital breaches. Another common issue we come across is regarding shareholder and member loans and or contributions. So firms can find themselves in breach positions even though they may have put cash into the business, but they may not have prepared the correct documentation to authorise the capital issue. Therefore, the transaction was sit as a loan on the balance sheet and not qualify for regulatory capital. Another point to note is that it is very difficult to backdate intended capital issuances after the transaction has occurred, in particular for limited companies. So I think the overriding message is while cash is obviously vital for all firms, it does not necessarily equate to regulatory capital. So firms should be proactively monitoring their capital and cash positions together going forward, even when they may have had periods of good performance.
Okay, good, thanks. Yeah, I mean, I guess it's important with regards to particularly the deferred tax arrangements that are in place at the moment that we shouldn't forget that those are still, there are still liabilities that remain on the balance sheet and will have to be paid at some point in time. So I've had some questions coming through about will the slides of the webinar be available after? Yes, we are recording and we will be sending slides out or making them available if people get in contact with us after the webinar. Okay, good. Just going back a couple, I think I missed a slide for Priya with regards to ICAAP and we have questions on this as well. Where do the Pillar 2 requirements fit into ICAAP documents? How is seeing ICAAPs being revised? Sorry, Becky, I'm putting you on the spot in terms of going back here. Priya, do you want to?
Yeah, absolutely. Yeah, I mean, the main thing about ICAAP, which we have been discussing with a lot of our clients over the last few weeks, is that the whole of the Pillar 2 assessment sits within the ICAAP anyway. So why is it different now? I think it's the timing. So if you're a December year end, you've most likely started your ICAAP process back in October or November and wrapped it up by February this year. Which presumably means that you haven't actually addressed risks relating to this pandemic within your ICAAP. If you're a March year end, then your ICAAP process is open at the moment, and then you cannot just roll forward last year's ICAAP to close it. The point to be noted here is that assessment of ICAAP is expected to be an ongoing process. So you have to bring the current impact within your ICAAP, whatever year end you are. And if the FCA were to review your ICAAP at any point during the rest of the year, they will expect that it has been updated for the risks faced by the firm due to the pandemic. And just as I mentioned ICAAP for completeness purpose, it is essential that you have clearly articulated the governance process in place, the senior managers who have to take responsibility to ensure that all elements are in order. And without opening another plethora of requirements under the SMCR, it must tie back to the statements of responsibilities of the senior managers. Someone in the firm must have put down in their SORs that I'm responsible for capital adequacy monitoring process. And under SMCR, one message that the FCA have kept reinforcing is reasonable steps. Senior managers being able to demonstrate that reasonable steps have been taken to control any situation. And this event really calls for it. And also contingency planning, which usually gets discussed in an ICAAP. Again, in the current scenario, this may be something that firms might be compelled to tap into. So worth reviewing your ICAAP to make sure it's complete.
Okay, thanks. Just staying with you, and we can forward a couple of slides now, Becky. I think just to move on to the role of the FCA over the last 2 months. We've seen advice on financial resilience with the FCA emphasising the need to plan, conserve, maintain, assess, and update. And I think the next slide, Becky, reflects their wider stance quite well. The communication from the FCA can largely be categorised to reflect the role it's played in protecting the consumer, supporting authorised firms, and perhaps an additional box might be titled "Helping Borrowers and Rishi" as the implementation of various COVID-19 schemes that require the FCA's assistance. Priya, is that a fair assessment?
Absolutely, that is a very fair assessment. The FCA have been very supportive in taking proactive steps to reduce burden on firms, to help them protect business, consumers, investors in general. Everything we have on the slide there are specific measures taken by the FCA to protect and assist regulated businesses survive through the storm. Life's gone tougher, budgets have gone tighter, remote working, loss of human connection, pause on new products or new opportunities are just some of the very basic practical impediments in 2020, which were never anticipated, and not to mention any personal issues that individuals could be facing. So it helps to know that some of the reporting deadlines are extended. A lot of additional legislation, which we would have been dealing with right now, has been pushed into the future. Larger firms who are required to maintain capital buffers on top of their Pillar 1 and Pillar 2 requirements are temporarily allowed to dip into their buffers if a need arises. The FCA have also said that if you are facing any financial difficulty or a likely capital adequacy breach, then you must contact them as soon as possible, and they will consider each firm on a case-by-case basis to see how best they can accommodate. On the other hand, if you have massive reserves and you intend to pay out dividends during the year, then it is likely that the FCA will want to dig a bit deeper into understanding and ensuring that you're still within the limits of your maximum distributable amounts. So on the next slide, we have listed all the announcements made by the FCA over the past 8 weeks, These are announcements mainly relevant for FCA solo regulated firms in the investment management sector. I've omitted everything that was published for insurance, mortgage, and consumer credit sector because that's not relevant to the audience we have here today. I've also not included announcements made by the PRA, Bank of England, AIMA, or the EBA, but we are separately tracking them and will communicate where necessary through our newsletters. I won't go through the full list here, but just a few points I wanted to highlight, just because they have a longer duration, so worth noting. Obviously, we have discussed regulators' expectations around resilience in depth, but one thing I wanted to talk about was expectations under SMCR. Whilst it is expected that all prescribed responsibilities are duly discharged, the FCA have now temporarily introduced modification by consent notification. It will be in place till April 2021. What it does is allows you to arrange a cover for senior manager for a period of 36 months without being approved. This is, of course, if a senior manager is absent because of coronavirus or you are unable to recruit an appropriate senior manager because of the pandemic. Also, please continue to document any reallocation of or amendments of senior management responsibilities or prescribed responsibilities by updating the relevant documents. Professional qualification exams was the next point I wanted to touch upon. Since most accredited bodies and professional qualification providers have cancelled exams, most of them with no specific arrangements in place to reschedule them, the FCA have extended the 48-month requirement to 60 months. However, they have insisted that they still expect all employees to have the skills, knowledge, and expertise needed to discharge their responsibilities. Although no action will be or likely not to be taken against the firm, the FCA will want to see that best effort has been made to seek alternative arrangements. I suppose this sort of ties back to the reasonable steps expectation from senior managers. And lastly, if you handle client money, there are several leeway or alternative measures to be put in place in relation to handling checks, depositing client money, notification of cash breaches, and completion of cash audit itself with your auditors. Happy to discuss this offline with whoever is relevant to.
Thanks, Priya. And what are the plans for the future? Back in February, I guess the talk was all to do with the new regulations, imminent discussion papers, Brexit planning, IFR. I assume most of these have all been delayed.
Yeah, we can potentially expect the FCA to publish some specific guidance relating to their expectations as the Brexit transition period is set to end in less than 7 months. But I do think that most firms have actually done their Brexit planning in 2019, so it's probably sitting in the sidelines or perhaps looming larger than ever. But we're just seeing the Brexit conversation restarting, although it's a much lighter topic than what it was once. We're also hearing about initiatives in the industry where a lot of due diligence questionnaires, which had Brexit-related questions painted all over them, are now being replaced by how firms would handle pandemics. So I think contingency planning for the future is one area where we can expect the FCA to throw some light very soon. Firms could be expected to have a contingency plan in place to address the responses to the risk of relapse. What is the trigger point in case we see a second wave of virus? We might also see some updates relating to planning around how your employees will return to work, the health and safety measures around it, and the operational and logistical issues that we all face. So watch the space.
Yeah, I mean, yeah. So, yeah, we do have a question that's coming on IFR, and you know, this was certainly a key area we were planning seminars not so long back on this new regulation.
Yes.
What has come out from ESMA? Is there a kind of any indication of likely delay, or when do we expect this to be introduced now?
We haven't seen any notification specifically from ESMA about the date. So the original date set is June 2021, which at the moment still is in place. However, the FCA's consultation paper, which was supposed to come out at the end of 2019, didn't come out not because of the COVID-19 situation, but it was expected then in Q1, and that hasn't come out, and now they've indicated Q2 2020, which again, obviously there's no indication as yet. What we have on the slide there are literally all the publications that's actually an extract from the FCA's website. And what we have there is literally a list of what they have indicated as the tentative dates of publications. With the prudential requirements for MiFID firms, which is the IFR and IFD, and although the timing is slightly up in the air, the point to note is that this will bring about significant changes to capital adequacy rules. The K factors which you need to calculate as part of your capital requirement, depending on the classification of your firm, can be quite complicated. Also, when I talked about Pillar 2 assessment earlier on, and I said that it does not apply to the to exempt CAT firms, well, this regulation brings it into force for exempt CAT firms as well. Base capital requirements go up for most firms. Fixed overheads requirement becomes the minimum norm to be calculated. So it's a complete overhaul of capital adequacy rules. And like I said at the beginning, in an ideal world, a lot of our clients would have had to prioritize this at the moment, and we would have been working with them to help them comprehend this regulation. But given the likely extension that the FCA may announce, this can be delayed slightly, but it doesn't go away. So I suppose to sort of conclude, the overall message from the FCA at the moment is to plan ahead, conserve capital, maintain capital adequacy, assess liquidity, and update your ICAAPs and wind down plans.
And stay alert, no doubt. Okay, thank you, Priya. Antoine has been waiting patiently in the wings, and perhaps we can now turn to taxation and how it might inform decisions concerning capital adequacy structures. Antoine, what are the key considerations for financial services businesses?
Thank you, David. I should apologise in advance in case the squawking magpies go at it again. So they seem to have taken residence in my garden. To my mind, there are two overriding scenarios in play when focusing on the tax considerations arising from capital adequacy. The first is capitalisation of the group, subgroup, or a particular entity in question, and the second is the pricing policy of the group. When considering UK FCA regulated managers and advisors, these are typically established either as UK incorporated resident companies or LLPs. So in that context, looking at the first scenario, in other words, whether or not to capitalise these entities to maintain capital adequacy for reg purposes, typically this is done via equity or debt financing. And if, for instance, capitalisation is effectively a form of equity into UK resident company, then any dividends are going to be paid out of post-tax profits. So although no deduction is going to be available for corporate tax purposes, the UK doesn't withhold tax on dividend distributions paid from UK companies. If capitalisation is instead effected into a UK resident company in the form of debt, then assuming the financing cost is on arm's length terms, a corporate tax deduction at 19% should be available for the financing cost. However, withholding tax may need to be levied at source at 20%. So in both circumstances, it's of course going to be important to determine who the investors are, who the shareholders are, and the nature of their tax profile. So if they're non-resident, for example, then they may be able to access treaty relief to reduce any withholding tax that might otherwise be suffered. A further point to consider is UK tax resident but non-UK domiciled individuals, so non-DOMs, may have been reliant on the remittance basis of taxation for income tax and capital gains tax purposes. We have numerous FCA regulated clients with principals who are non-DOMs who are going to have to be careful potentially remitting sums into the UK if they are considering capitalising their UK operations, as it could trigger UK income tax and or capital gains tax liabilities. Also vital to the capital adequacy position is an understanding of how the UK FCA regulated manager advisor generates its revenues and whether it's going to be profitable or loss making based on its current pricing policy. Key to this is going to be understanding the complete value chain of a group and the UK FCA regulated entity's relative value within that group, so as to then determine how revenues are shared between group entities. From a UK tax perspective, intragroup transactions entered into will typically need to be transfer priced to ensure the UK operations are remunerated on arm's length terms. So in other words, they're remunerated commensurately with the level of activities undertaken in the UK. Often groups use a revenue or profit split transfer pricing methodology to remunerate their UK operations, and this would ensure under normal circumstances UK operations are suitably profitable. But capital adequacy problems can arise when a group is loss-making overall, as a UK manager advisor may only be entitled to a share of revenues that gives rise to a loss in the UK. So, considering temporary solutions to the capital adequacy problem, one example, one temporary solution could be a change in transfer pricing policy. So, potentially shifting towards a cost plus pricing methodology or similar. And of course, from a capital adequacy perspective, this may help to bolster local reserves in the UK. But there are a number of interweaving factors to bear in mind, including, of course, how such a short-term pricing movement, pricing amendment might be perceived by HMRC. So does it, for instance, undermine the existing pricing policy that's already in place? Another point to note is how tax authorities in each jurisdiction where the group is based might react. So for instance, although HMRC may be comfortable getting an increased share of revenues and profits and therefore increased tax revenues in the UK, inevitably that drains the tax revenues elsewhere. So how might the IRS or other tax administrations consider the changing pricing policy? And another point to note is of course how a change in the transfer pricing policy might impact other domestic factors. So in the UK, for instance, if with individual members of a UK LLP changing to the LLP being remunerated on a cost plus basis might impact the reliance placed on failing the conditions of the UK's salaried member rules, for instance.
Okay, yeah, I think transfer pricing, I think, is certainly a topic I've heard people discuss, certainly with regards to trying to second guess government policies in different countries. We're certainly expecting the US to adopt protectionist policies as well as other countries, but I guess the big question on everyone's lips are, will taxes go up in the UK? What do you think?
Yeah, no, I think it's a very valid point. As you rightly say, that there could be an increase in fiscal tightening globally, including the UK, and certainly it feels like we're going to be paying off these debts for decades to come. Touching on areas where HM Treasury, HMRC could potentially try to tighten fiscal policy in the UK. An obvious measure that has been tinkered with in the past and certainly would capture headlines in the UK would be reintroducing a top income tax rate band of 50% over a certain earnings threshold. Other top rate measures could also be amended. So headline rates of corporate tax could also be increased and viewed as politically positive. But although increases in measures like that might be considered positive politically, I think the reality is very different. I think the reality is much more that the increase in tax revenues would be a drop in the ocean. And actually, I think more likely would be that any increases and any new measures would have to go hand in hand with other tax raising measures as well. So, for instance, a special top rate of capital gains tax of 28% is currently already in place for certain carried interest returns and residential property. Could this top rate of capital gains tax be extended to other gains? Also within the gains regime, there's been a recent erosion of entrepreneurs relief, now business asset disposal relief. Is this something that could be eroded further or eliminated entirely? Another politically sensitive regime is the UK's non-Pom regime and the remittance basis of taxation. Of course, the regime has been with us for decades, but it has been gradually eroded over the years. For instance, the remittance basis charge was introduced back in April 2008 and has been extended numerous times since, making it increasingly expensive to access the remittance basis of taxation for income tax and capital gains tax purposes the longer an individual remained UK tax resident. And more recently, from April 2017, legislation was enacted that meant long-term UK tax residents needed to be cognizant of becoming deemed UK domicile for income tax and capital gains tax purposes after being a UK tax resident for 15 out of the last 20 tax years. So, you know, could this sensitive regime be eroded further as well? Another set of fiscal tightening measures that could be introduced might be a combination of capital tax introductions, wealth or mansion taxes, for instance, or a corporate equivalent of capital or balance sheet taxes or levies. But my personal view is that such capital taxes are highly unlikely to be introduced by a conservative government in the UK, because they can erode the capital base, and even where a particular business might be loss-making or an individual might only have negligible amounts of income. I think any capital tax policies are considerably more likely to be introduced by a future Labour government. Personally, I think there's going to be a renewed focus on tax transparency, increased disclosure and targeted anti-tax avoidance measures for businesses and individuals alike. It certainly was already the trend before the pandemic, and I can only see HMRC being allocated increased resources in the area, in this area, because, you know, in their combat against tax evasion, tax avoidance, and perceived abuse.
Yeah, I guess the other school of thought is that taxes can't possibly go up, as we need to kickstart the economy, and with Brexit, we need to be more attractive than ever to foreign investment. So actually, it might pose some planning opportunities.
Absolutely, as you say, I think you're right. Too much fiscal tightening too soon could certainly have a detrimental impact to tax revenues, given the sheer number of businesses and individuals that are being severely impacted by the current situation. We've been discussing the school of thought that there may be some significant fiscal tightening in the UK, and if that view is taken, that there will be increases in rates of tax, there will be erosion to specific reliefs and preferential regimes is likely as well. Some thought should certainly be given to whether or not to bring forward the crystallisation of gains or income distributions at lower rates of tax. So, for instance, some UK managers structured as companies have considerable retained earnings on their balance sheets, and assuming Reg Cap requirements can be met, could dividend distribution be brought forward to crystallise early income tax liabilities? Equally, some UK management companies may also be heavily capitalised, and again, assuming Reg Cap requirements continue to be met, could there be an early capital repayment, triggering an early capital gain, giving rise to a crystallisation of early CGT liability for UK tax resident principals? Thinking about ultimate beneficial owners who are UK tax resident but non-UK domiciled individuals, might it be beneficial to them to crystallise early non-UK source income distributions and gains before, you know, further potential erosion of the remittance basis regime? And certainly, you know, given that tax administrations globally are going to also have the same pressures on increased fiscal tightening over the coming years, multinational groups who may have non-UK holding companies, holding structures, should also think about whether or not to crystallise early distributions or gains that may be taxed at reduced rates or under preferential regimes in those local territories too. In my mind, however, there are two factors that align that may serve to restrict fiscal tightening in the UK and create potential opportunities of establishing a UK presence or increasing FCA regulated operations and substance in the UK. As we discussed previously, one factor is the school of thought that too much fiscal tightening too soon could have a detrimental impact to tax revenues, and of course that's going to be relevant to tax administrations globally. The second factor is the opportunity that presents itself to UK regulated businesses in the form of a post-Brexit transition environment. Clearly, the UK and London in particular already has considerable infrastructure in place for financial services businesses. And actually, to put the size and importance of the sector to the government into context, in the year to 31 March 2019, the financial services industry accounted for over 10% of total UK tax revenues. So as we approach the post-transition phase of Brexit, it certainly feels like it creates a real opportunity for the government to develop and maintain a competitive tax framework for alternative asset managers and financial services businesses in the UK. One that's fair, certainly one that's transparent, and that also seeks to provide increased certainty to these regulated businesses, their principals, and other stakeholders alike. There are already examples of how the British government and the asset management policy teams hope to do more to attract and retain alternative asset management businesses in the UK. And yeah, as we know, it is a sector that is known for its relatively mobile workforce. So I'm sure they will do as much as they possibly can to keep us firmly in the UK.
Okay, yeah, thanks. And yeah, I mean, when I was at the start of this, when Rishi was announcing the schemes, particularly for the self-employed, I think Rishi Sunak, the Chancellor, is intimated that the taxation of the self-employed would be brought in line with the employed to reflect the fact that they were getting similar levels of support from the government. Does that mean that, you know, basically, if any taxes do go up, the first one will be NI for the self-employed?
Yeah, national insurance, I think, is another one where it doesn't make the headlines as much, but certainly I think national insurance could be one of the measures that are also increased. And the other point that I would make is that self-employed were already being targeted, I think, in advance of this pandemic. So the reality is, I think we'd just be getting back to the gradual erosion of the sort of tax difference that exists between being self-employed and receiving allocations of trading income from LLPs to being employed. And certainly, you know, it's you know, groups that have significant UK operations, that they may be attracted, they may continue to be attracted by the LLP as a flexible choice of vehicle out of which to do business. But some heavy multinationals, I think, are certainly preferring a wholly corporate route in the UK. But certainly it's going to be dependent on the facts and circumstances of any particular group.
Okay, thanks, Antoine. We have had some questions come through, so if I can put some of the speakers on the spot. I think we've got 5 minutes or so left. If people want to hang on, we'll go through those questions now. Just to confirm that we'll be putting the webinar and slides hopefully on our own website, as well as we'll try and do that on the AIMA website as well, if that's possible. But if people do want to email us direct, we can also send those through to people direct. Just so, Jonathan, just one question regarding the capital requirements. Audited reserves are tier 1 capital, but are not necessarily permanent as they fluctuate. How do you account for this?
Thanks, David. Yeah, I mean, it's correct that audited reserves can be classified as tier 1 capital. But we just recommend that firms consider whether these are actually going to be retained in the business for the future, and obviously for the purpose of meeting those regulatory capital requirements. And I mean, if you do know that these are going to be distributed out of the business, then it would be prudent in your monitoring and forecasting not to include these. I think also for LLPs, any P&L that's earned during the year needs to be allocated amongst its members for tax purposes. So it would potentially follow that, obviously, that these would be distributed unless there was a specific measure that was taken that these were going to be retained again in the business to meet the Reg Cap requirements.
Yeah, and I guess they don't necessarily fluctuate unless you've got losses in post audit that erode into those audited reserves. But okay, thanks. For CPMI firms, if the sum of the credit risk and the market risks are higher than the FOR, would you use this figure in the CPMI Pillar 1 calculation Current guidance only mentions FOR. I don't know, Johnny or Priya, I don't know which one of you want to take that one. No, none of you.
Yeah, that's fine. Yeah, I can take that. Yeah, so the sum of credit risk and market risk is your and versus the fixed overhead requirement is the sort of your MiFID capital requirement. Under AIFMD, your capital requirement is based on your fixed overhead, the higher of your fixed overhead requirement, and your sort of funds under management requirement, and then additionally the PII portion of the requirement. So, in answer, if the credit risk market risk is higher than the FOR, that would increase your capital requirement under MiFID, but then for the requirement under AIFMD would be treated sort of separately. So then you'd look at those two separate calculations, and then under AIFMD and under MiFID, and then whichever the highest we would take as of your overall kind of one capital requirement.
Okay, thanks. I think this one's for Priya. Future AUM relies on the returns of the fund. What is a suitable estimated return to use in forecasting AUM? That's yeah, well, I guess that's what the scenarios are for. Priya.
Yeah, I think that is a very good question. And actually, it is one question that our clients ask us all the time. I'm assuming this is being asked from the point of view of estimating the funds under management requirement under AIFMD. There is no concrete answer to that in terms of what you expect your return to be. It just has to be estimated based on your strategy, based on your outlook for the market, based on events such as COVID. When we do Annex 4 reporting for our clients, we see such a massive fluctuation quarter on quarter for our clients, just in terms of the actual questions that go into the return relating to expected returns. And between December reporting and the March reporting for some of our larger AIFM clients, we've seen a significant drop in their expected returns, taking into account the COVID-19 situation. So the point here, which probably helps, is if you're asking from the point of view of funds under management capital requirement, you have 6 months to actually project your funds under management and use those projections for a period of 6 months, and not allow the fluctuation in between to affect that number which you have used for estimating your capital requirement. And that's as per the FCA's guidance, which specifically came out on AIFMD Annex 4 reporting. So you don't have to worry about it month on month. You can probably cap a number for 6 months, but then look to change it after 6 months.
Okay, thanks, Priya. I think we are almost up. If there are a few other questions that we haven't got to, but hopefully we can come back on those. If not, please email us with those questions. So I'd like to finish by thanking all of our speakers and AIMA for the opportunity to host this webinar. And a special mention to Becky Maycock, who has been behind the scenes produced, and Sean from our IT team behind the scenes trying to produce and very ably going through our slides. So thank you, Becky and Sean. I hope everyone found the topic interesting and relevant. I'm sorry I haven't had the chance to ask all those questions, but as I say, send those through. There's the various offers that we do have available to AIMA members that are on screen at the moment, so please get in touch if you're interested in those. Reiterate again, the webinar is recorded. We'll see if we can put links on our website and AIMA's website, so hopefully anyone that's had any technical issues, I know we did at the start, that they've still got access to that. Thank you for joining us. I hope you get outside to enjoy the sunshine, and please stay safe. Thank you.